Hello, this is Dr. Adam J. Bach. In this short audio presentation, we're going to talk about revenue models. We'll describe what a revenue model is, briefly talk about types of revenue models, spend a little time thinking about this concept of free in the tech context of revenue models, talk about revenue and cost drivers, in particular with reference to the business model, and then think a little bit about pricing. So a revenue model identifies how the company will earn and generate profits. You might be thinking to yourself, wait a minute, didn't we talk about this already? Wasn't this business models? And that's a great question. Thanks for asking. But we do want to distinguish between a business model and a revenue model. So a business model addresses the broader scope of how an organization creates and captures value. It has to do with the design of the organization, addressing an opportunity. A revenue model is focused only on the transaction, that transaction mechanism with customers, and the cost buildup that supports that transaction. So a revenue model is really kind of a part of the business model, right? It's equivalent to the operational process associated with capturing value. So if that's not particularly clear, then I'd encourage you to go back and take a look at the presentation on business model, reread the chapter in the textbook, make sure you're clear on the distinction between these. You're not alone in having this confusion. For decades, people understood the revenue model to be the business model, but it's only in the last 10 to 15 years that we've really been able to clearly distinguish between the two. There are many different revenue model possibilities, and there have been a lot of efforts to create a typology of all possible revenue models. And I'm not sure that one exists. I mean, I think that there's just a lot of different ways that organizations can actually generate the transactions that capture value. Typologies can be helpful because they can identify challenges or opportunities based on looking at other organizations that are using a similar kind of revenue model. But at the same time, you want to be really careful, right? A revenue model is not inherently good or bad, just more or less viable. So when you look at revenue models, sometimes it's pretty obvious what the right revenue model is, but you want to be careful about sort of saying, well, this revenue model is just not possible, or this is a bad kind of revenue model, but be aware of the distinctions. And organizations can use multiple different revenue models or even change their models over time. Recognize that when we begin talking about investors, some revenue models are much more attractive to investors. In particular, recurring revenue and subscription revenue models are really interesting to investors because once they're in place, customers tend to be locked in, and investors like that from a scaling perspective. And at the same time, there are disadvantages to those revenue models because they're often more difficult to implement. You're not just selling a customer on today's sale, you're selling them into the future. So recognize some of these distinctions and some of the elements that distinguish between the different kinds of revenue models. Your textbook walks through a variety of revenue models, everything from unit sales and advertising, intermediation, which is the process of operating between different parties such that those parties get what they want and you get a piece of the transaction. Subscription models, which you're probably very familiar with. Utility and usage models, those may not sound familiar, but actually they're very common. You might recognize them from things like utility bills, but they could also be data services, depending on how much data you use. Freemium and cross-subsidy models and multi-party models. You don't need to be able to define every single one of these perfectly, but you should be able to recognize them well enough that if, for example, one of them popped up on a quiz or an exam, you would be able to pick out the correct definition or example from a couple of multiple choice responses. Multi-party revenue models have become much more popular in the last 10 years or so. And I've provided, this is from your textbook, a table that kind of walks through some examples. And you might want to think to yourself, why have these multi-party revenue models become so much more prevalent, even in the context of non-sort of leading edge technology companies, right? So some of these organizations obviously relatively leading edge, some of them not quite so much. And so I'd encourage you, think about what is it that's associated with the internet and data and information that makes multi-party revenue models attractive. And think about how these organizations actually generate revenue and create value for customers, and I think you'll gain some insights into why multi-party models have become more prevalent over time. And the key word in almost all of these cases is the word subsidy. So that's your clue if you need to think about this in a little more detail. A business model is a great place to start for putting together your revenue model, right? And because the business model has two of the most critical pieces of the revenue model baked right into it, right? The business model canvas right at the bottom, cost drivers on the left, revenue structures on the right. So as you're thinking about revenues, you should be thinking about who those customers are, how often they buy, what the process is, what price you're going to be charging, and you want to make sure that you're testing hypotheses incrementally, right? You don't want to just guess and say, well, I think we should charge $5 for this. There should be hypotheses associated with whatever it is that you're selling that you can test on an incremental basis. And then obviously, as you begin thinking about costs of goods sold, if that's relevant, obviously many online businesses, non-physical businesses don't have significant cost of goods sold, but they do certainly have operating expenses. Those could be salaries, they could be rent, they could be servers, and then various regular and extraordinary expenses. And the one thing that often first-time entrepreneurs and students miss out on is post-sales costs. For many organizations, your costs don't end once you've closed the sale. There are other costs that you may have to incur, even if most of your customers don't do anything specific with you after the sale is over. So good to be thinking about these things. There's no definitive list that can be used for every possible organization, but as you think through how a company operates, and as you think about how its business model works, you should be able to come up with most of the key revenue and cost drivers. Pricing used to be considered an art form, and people were paid well for coming up with pricing systems that generated excellent sales. But in the modern era, the advent of more sophisticated approaches to customer behavior, observation, data collection, use of data across platforms. So someone uses an app for some things, which then gives you an indication of what those, of how they're likely to behave in other circumstances, as well as the availability of data, has made quantitative dynamic pricing models much more prevalent. And a great example of this, of course, is airline seats. The price you pay for an airline seat is going to be dependent not just on the route and the carrier, but when you purchase the seat, very early in advance, right up until the end, and so on. And these dynamic pricing models are incredibly powerful for extracting more cash out of customers. The reality is that most startups are going to struggle with pricing, especially because they have limited resources to investigate customer preferences or generate sophisticated models like dynamic pricing models. The bottom line is that at the start, you should be observing your customers and your competitors. You should talk to experts and then conduct experiments if at all possible. If you've kind of lost track of the whole experiment thing, you might want to check back into that chapter and presentation. You can price high and then lower that price as needed. Why? Well, because that's a lot easier than raising prices later. Most entrepreneurs are under the misimpression that they should charge the lowest price possible at the start in order to get as much sales as they can. That is not normally what I recommend to my consulting clients and the entrepreneurs that I mentor. Price as high as you can and then lower it when you need to, right? Otherwise, you're leaving money on the table. Lowering price is pretty easy. Customers go along with that. But if you start with a free or nearly free product and then you have to raise prices, that is likely to be an uphill battle for sure. So pricing strategies, not the same as revenue models. Your textbook provides a whole series of different pricing strategies, from competition-led pricing and customer-led pricing, to kind of classic loss leader strategies where you price something below how much it's really worth in order to get people into a store on a site. Classic examples of introductory offers or skimming, psychological pricing, which is buying based on their beliefs or their expectations, and then fair pricing and bundled pricing, which are sort of slightly more modern perspectives on how pricing can actually function. Again, you don't need to be able to define each one of these perfectly, but you do need to be able to spot them and identify them based off of, say, a multiple choice question. Some pricing calculations that are worth at least being aware of. Maybe one of the most important ones is break-even pricing, which is recognizing how much you have to charge in order for your organization not to lose money. This equation's a good one to know. It's not that hard to figure out. And I believe I've provided a break-even example video in Canvas for you to take a look at. Cost plus or cost led pricing, pretty straightforward. Classic example is purchasing wine at a restaurant. Usually the markup on the wine will be roughly 200% of what the retail price of the wine would be at a store. Target return, which is quite sophisticated, that's identifying what your investment return expectation is for the organization and pricing to achieve that. And then a value-based pricing process in which you recognize and have some mechanism for calculating the value that's created for your customers, and then you price presumably below that. You can't price above it, but you price below that, but higher than your cost basis. Realistically, as an entrepreneur, you'll take what you can get, right? So if you can do one or two of these calculations, then you should triangulate, experiment, and be prepared to adapt. Arguably, the right price ultimately is the one that helps you achieve your critical organizational goals, whether that's growth, profit, exit, impact, job creation, whatever that happens to be. So pricing and revenue models work hand in hand, obviously. You've got now a summary of key concepts associated with it, and this should give you some perspective in order to assess how other organizations are thinking about their pricing, or if you had your own innovation, how you could initiate the pricing process in order as part of your early experimentation to see how customers actually behave.